Hey everyone, welcome back to another Meet Kevin report today. Wow, there's a lot to cover. I obviously wasn't here on Friday, and boy, it's been an eventful weekend with what's going on in Russia. We've got Tesla news to talk about. We've got market news to talk about, commodities news to. There was endless stuff to talk about this after this weekend. And boy, I wish I could have been covering everything this weekend, but I'm getting over this weird cold or slash jet lag slash exhaustion combination that hit me after Canada. So apologies, but here I am, mostly back and ready. Okay. With that said, let's jump right into some of the latest in terms of what's going on. I think we probably ought to start with Russia, but maybe we'll start with a quick preview of markets first. Markets right now in pre-market slightly trending red. We'll see how things go once the market actually opens, but down about 5 bips on the Dow, 13 on the S&P, and Nasdaq down about 20. We've seen that though, as according to Deutsche Bank at least, we've seen investor flows most negative for tech stocks. ETFs had their first outflow week in about 13 weeks in a row. Everything's just been inflows, money going in into stocks, especially if people have kind of been FOMOing back into the stock market. I think most of that and the headlines that we see about people, moving in to out of fear of missing out is well, really because a lot of folks have positioned in high yielding cash accounts, whether those are your cash yielding bank accounts or treasuries or whatever it might be. And you can't really blame folks for doing that. I mean, treasuries have been offering over 4.5% for coming up on a year now. So why not? Well, why not? The answer, why not, is opportunity cost in stocks. And more people begin to recognize, oh, wait a minute. Maybe we won't end up getting Paul Volckered. And maybe once the inflation genie is out of the bottle, it can go back in the bottle. Maybe then we should be in stocks before that happens. Anyway, that has led to a lot of this 13-ish week rally that we've seen here with some volatility there around the banking crisis. But of course, all things must have a little break, especially in the stock market. I think the easy comparison to make is back to really, if you look at 2010 to the 2020 period, very, very normal to have rallies and then volatility to the downside. Although what's quite interesting is, as we've seen recent downside in the market over just the last maybe 4 trading days, we've seen markets red. We haven't actually seen the volatility index, the VIX or fear index, rise pretty much at all. If anything, we're actually at sort of all-time lows, which is making some folks argue, especially the bears, that maybe that's because the true pain is still ahead of us. And maybe just because we're technically out of the bear market and we've gone into a new bull market because we're up 20% from the bottoms, maybe we're going to be a lot more like the 2000 to 2003 period, where we ended up having to create a new bull market with the S&P 500 3 times before it actually finally stuck, which meant we had a lower low and a lower low to go twice before we actually got out of the hole. So I suppose that's also possible. But there'll be a lot of speculation and debate, and time will tell. As far as some of the movers here in the pre-market, last I checked, Tesla was down about 2% in the pre-market, following being red about it was red about 1.5% on Friday. It's actually down about 2.3 right now, sitting about that 250 level. You've got Google also down about 1.4. Open Door sitting at $2.90. You've got Facebook is, let's see here. How's Facebook doing? Facebook is actually up 27 bips in the pre-market, and Nvidia is only down 19 bips. It's barely come off the top. It's actually one to pay attention to from I think the view that probably any dip in Nvidia is just leaving the door open to new funds or institutional managers buying this, mostly as, in my opinion, lately a blind AI play. Now, that is not a diss on Nvidia. Don't get me wrong. I think they're extremely well positioned. to take a lot of money from AI compute, and I would much rather, I want to be crystal clear about this. I would much rather put my money in NVIDIA than speculate on some software that's going to become profitable potentially through artificial intelligence. I would be very, very skeptical about investing in software. I'd rather be at the picks and shovels end of this, which I think are the chips, chip designers, the chip manufacturers, and so on. Excuse me. Now, that said, I think it's going to be darn near impossible for NVIDIA to fall without some significant inflows. That's not to say that the stock can't correct. It's absolutely probably going to correct at some point. Uh, I'm just laughing at saying absolutely probably. I guess that doesn't really tell you my opinion. Well, I guess it depends. We'll have to see. See, there are two things that can happen with NVIDIA. Their server ordering could be a flash in the pan. In other words, you get a lot of companies that order the H100 server chips from NVIDIA, and once they've ordered them, they're done. So you sort of get like one cycle, 1 or 2 quarters of big orders, and then you sort of revert to a mean. That's a risk. Mean reversion in chips is probably your biggest risk. And even if you just revert to slightly above the mean, or you move the mean up, mean reversion could really hurt the valuations of an AMD or NVIDIA or otherwise. Although NVIDIA has always been valued a little bit more expensively than AMD. Now, if it is true that they can sustain the growth that is being projected by AI, well, then they'll continue to take a pretty large market share. Apple's still sitting at basically darn near all-time highs. All-time highs now at 187.56, and in pre-markets down only about 12 bips at about 186. Looking at the Tesla Fibbies, you can see we were rejected by the uptrend when we hop in over here. Rejected by the uptrend as we got stuck in no man's land right around 278. Really a no man's land over here. Couldn't make it past that. Unfortunately, there is some near-term downside risk for Tesla in that now we're struggling to hold the 257 level. In fact, we barely held 250. Well, we didn't hold 257 on Friday. That is a bearish catalyst for a Tesla dropping down to about 221. So something to keep an eye on. Volume's still relatively elevated as well. Okay, so with that, I think now we ought to jump into some Russia talk. Lots of Russia talk. We will talk about the comrades. Okay, so 1 second here. All righty. So let's see here. All right, everything's cooking with gas. Okay, good. We're fully functional. Are we though? Okay, Russia. So here's a high-level overview of the insanity of what's going on in Russia, focused mostly on what this means for Putin and Russia going forward. Let's be absolutely clear and blunt here. This is a massive embarrassment to Vladimir Putin. Could you imagine? I just want you to think for a moment. Could you imagine that, like a Blackwater, back from the early 2000s and late 2000s, the mercenary group in Iraq, contracted by the United States. Could you imagine them running a column of tanks down a highway in Texas? Do you actually think Americans would let that go far with not only our National Guard, but also just Americans themselves? No, it just wouldn't work. The fact that it was able to occur in Russia seems surprising to the world. In fact, so much so that both North Korea and China are, well, expressing their hope that Putin can quell this uprising and these problems and end up calming nerves. This is very important for Putin and the international community because this sort of embarrassment to China and North Korea is, well, not just embarrassing, but it's also really somewhat bad for China and North Korea and potentially even India. See, these other countries, they really rely on Russia. They really rely on Russia. They rely on Russia because Russia doesn't have a lot of trading partners. Russia's got an economy that's, somewhat decently functioning, but they're a massive oil economy. Excuse me. This is a big deal because what's happening is as there are price limits on Russian oil, that Russian oil is bought cheaply by India and other countries, even China, and then used locally for their own domestic production and manufacturing, which is good for their economies because they can buy discounted Russian oil, or they can buy it and resell it, profiting off of Russia. Nobody knows what a barrel of oil is actually containing. It's oil. It burns. We can create gasoline out of it. We can create plastics and other petrol products out of it. It's a commodity. By the nature of a commodity, there's no difference in one commodity to another commodity. Remember back in the day when Kevin O'Leary used to say that, well, there's dirty Bitcoin and there's clean Bitcoin, and there should be some sort of differentiation between the two. One thing that hasn't happened in Bitcoin is any kind of differentiation between the two, probably because it's not that easy to actually determine the difference. Much could be said about oil and its implications for China, India, even North Korea. These economies are relying on this cheap, stimulative oil that Russia is giving them, especially since China's economy is, I hate to say it, not doing very well. It's in the poopers. We just had a Chinese data that came out actually, and it'll show you why China is probably a little bit nervous about losing one of their larger trading partners in the event of a regime collapse in Russia. And that's what this mutiny is really signaling. This is much more than what's happening to the leader of the Wagner Group? Is he going to get killed? You've got a director of the former CIA director saying he's a dead man walking, which, by the way, I agree with. I actually think he's probably got a gun to his head or to his family's head, and he's either soon to be dead or is soon to disappear. And, people are making comments like, this guy's got to stay away from open windows. This doesn't seem like his narrative. He's speaking somebody else's narrative about, oh, yeah, I'm just going to go to Belarus and, leave Russia because they're going to drop the charges against me. Really? You ran 5,000 mercenaries and tanks through Russia, blowing through blockades and fighting with Russian helicopters because you were really worried about Putin's charges? Right. Oh, okay. If that's the mainstream narrative and we're supposed to believe it, okay. But anyway, finishing first here on China, I want you to really think about this as the larger picture, not just this mercenary group. I want you to think about how weakening this is for Putin and why that weakening for Putin makes the rest of the world that relies on Putin nervous. Consider again China for a moment. Look on screen now. China's holiday tourism moderates in June, but not only does it moderate in June, I want you to look at the level of trips compared to 2019. On the left side, you can actually see that in January and April, we had 80% of the trips that we had of 2019, and that's actually risen in May and June to about 115%. That's good. That's decent. But you know what's not decent? I want you to look at the right side chart. I'm going to hide myself for a moment. Look at the right side chart right here. What do you see? Average spending per tourist in China has never this year exceeded 100% of 2019 levels. This is bad. In fact, they just had their Dragon Boat Festival and many reasons to spend money in China. And what's happening? People are actually spending less money now than they're spending or were spending in 2019. This is not an economy that's growing at 5% like people suggest. There's a chance China could go into an outright recession. And you know what would drive China and North Korea and potentially even India into a recession or into an even worse economic strait, or one of inflation? Or one, of continued inflation to some regard, although China doesn't have too much of an inflation issue relative to the rest of the world. But what could do that? Expensive oil, expensive wheat, things that both could get more expensive with the collapse of a potential Russian government. And what did this real mutiny tell us over the weekend? Well, it told us that Putin doesn't have the control that we think he does. Or many of us may be already saying, well, we never really thought he had any control anyway. He's just a puppet. But he's always been seen as a puppet master. Remember when Dmitry Medvedev was the boss man in Russia for a while? Nobody actually thought he was. It was Putin who was really running the show behind the scenes. Going historical here. We don't have to be too distracted on that tangent. But consider this. This uprising shattered any appearance of stability that Russia really has. And this is dangerous for these other countries. And it's really probably a big positive for, frankly, the front lines of Ukraine. Zelensky and Ukraine should really be cheering this disaster, and they almost certainly are, mostly because Russia's already had a very difficult time recruiting soldiers. Not only do you have a massive labor shortage in Russia, much like you do in many economies around the world, but you have a massive soldier shortage to the point where Russia will essentially draft men and of fighting age, which is pretty dang broad in Russia. You could be pretty old, pretty young, and you got to go. And if you don't, you get sent to a work camp, basically a concentration camp where you can think and work really hard about why you didn't go serve. You would have wished you would have served. Most people would rather serve than be in a Russian prison. My assumption, of course. Point is, Russia's got big problems. This does not help encourage people to say, all right, I'm going to sign up for the Russian army. Now, I want you to think about this. The mercenaries, how many of them who are so fed up with Putin that they were willing to follow their leader in a march, well, I shouldn't even call it a march, in a near attack against Russia? The folks in the Wagner Group were willing to attack Moscow. And what? Now they're supposed to just go sign up for the Russian army? That's at least what the mainstream media is telling us. You got to be kidding me. And this idea of you got to be kidding me is fantastic for Ukraine, but it's bad for China, Russia, and India. And that's the point. It actually just strengthens the United States and Ukraine and Europe, and it weakens the developing bloc really on the other side of the world. Now, I'm not trying to pick sides here and say, stick it to China or whatever. I actually kind of feel bad for China to some extent because China's already going through some massive crap, from a real estate collapse to more real estate builders just collapsed over the weekend. You've got an economy that's, I don't think, growing near 5%. I don't trust the Chinese statistics. But then again, maybe I'm a little critical of China. I'm regularly critical of China. But I think China's trying to set themselves up as the best place to run a factory and to create your company. And they use Tesla as an example for that. And they're doing that because they have to, because they're lacking substantial growth. And it's going to be a bigger long-term issue. And this Russian issue is just adding fuel to the Chinese, India, and really side of the block that's anti-United States or not always aligned with the United States. So it props up the United States more. Long and short, what is bad for Putin is not so great for these other countries and ultimately a benefit to the United States. It's one of the reasons for the last at least couple years, but certainly over the last decade, I've made the argument strongly, but in the last couple years, more strongly, people regularly ask, Kevin, why not invest in India? Why not invest in these emerging markets? Well, India, all you have to do is research what happened with Adani a little bit. Hopefully get your answer there. But whoopsies, there we go. But when it comes to China, personally, my thinking is stay focused on American stocks that have exposure to China, but also be somewhat cautious. And this Russian disaster could actually give you some cause for caution for your Chinese exposed American stocks. those are actually going to be your NVIDIAs, your AMDs, your Taiwan semis, not to the extent that I actually think China would at this point ever invade Taiwan. That is certainly not a position that China is in right now. Their economy is substantially too weak for that. And after seeing what's happening in Russia, I think Putin is giving you the exact opposite of a reason to invade Taiwan. Think about this. When Putin invaded Ukraine, people said, oh my gosh, if Putin can do it, that means Xi Jinping can do it. And he's going to invade Taiwan. Yeah. Well, how did that go for Putin? He literally had mercenaries run tanks within, 2 hours of Moscow? They had a whole 14-hour path to go. And it was like 12 hours later, basically right on time, a deal happened to be made just as mercenaries were, an hour and a half, 2 hours outside of Russia, outside of Moscow? It's absolutely insane. Point is, this is a massive signal to even China. Don't even think about touching Taiwan. So think about what I'm stitching together here. What I'm stitching together is Putin is weak. This is a massive, massive embarrassment to Putin. It is such an embarrassment to Putin that when the mercenaries turned around, they had to have a fireworks show in Moscow and play Russian anthems. It's all propaganda. It's ridiculous. But we already know that. But consider the follow-on effects. This means lower risk of conflict between China and Taiwan. It means greater chance of success with Ukraine, harder opportunity for Russia to continue the war. It also means potentially a weaker economy for India, China, North Korea, as if the war falters, potentially oil prices rise again, inducing some inflation for those countries. Bye-bye cheap stimulative oil. Go back to paying normal prices for oil. But regime change, could also be a big hit to, purchasers of Chinese goods or Indian goods, which Russia is, and vice versa. Very large trading partners. So, So, what does this mean? Well, it means that this Friday we have a price increase for the courses on Building Your Wealth, link down below. But you already knew that because it's going to be June 30th, and this weekend we'll be releasing a whole host of new lectures in honor of that expiration coming this Friday. We've got a lot of work already going into those lectures, and I can't wait to post them. We'll have new stock lectures as well, including some that many of you have been asking for on options volatility. So we'll have some more on that. And options in general. But anyway, continuing here with Russia, another potential aspect of this disaster that occurred this weekend for Russia is that you could literally have people within the Russian army just give up. Now, that is relatively risky because those folks would probably serve severe prison sentences or just be executed, which isn't necessarily a good choice. But a lot of folks are now speculating that maybe if the Wagner group goes to Belarus, and then maybe there's some way where all of a sudden Poland's like, hey, if you're a defected Russian militant and you happen to go to Belarus, and then we happen to let you in over here, now all of a sudden what you could potentially open up is a path for a Russian soldier to quit the Russian army via Belarus and then into Poland as, becoming a citizen. That kind of path is one way of draining Russia of its important resource. Fighters, soldiers. And if you could potentially do that, you could bleed this war dry of the resources it needs to go on. People in a situation where their lives are being used as basically pawns in a war. Now, it's also worth noting that Putin has not been seen in public since denouncing the mutiny and threatening this harsh punishment. He never mentioned the Wagner chief by name. And also, you've got the Wagner chief, a lot of people looking at photos that came out of him yesterday, and they're like, huh, where's the person with the gun to his family's head? Because it's really weird that all of a sudden you would just U-turn your mercenary army an hour and a half. But whatever, we'll just believe the mainstream narrative, I suppose, that he just had a change of heart and was convinced by the Belarusian president. Right. Okay. Anywho, so continuing, Secretary of State Blinken believes that this Wagner uprising is a big benefit to Ukraine. There have been a lot of jokes going around that the Wagner Group is probably about to sign a $6.2 billion contract with Ukraine and end up flipping sides and working with Ukraine. And Zelensky making the argument that the enemy of my enemy is my friend. And if the Wagner Group is the enemy of Putin, then the Wagner Group is a friend of Zelensky. Obviously, that's both of these are a joke. They're a reference to the $6.2 billion accounting error that the Pentagon happened to make. I don't actually think there need to be accounting errors for money to get smuggled to or via the CIA to, groups that you wouldn't want to see money go to. So as much as I know that people are making jokes on the internet about, oh, $6.2 billion, it's going exactly here, there, or whatever. Trust me, they don't need to make accounting mistakes to spend money on exactly those things that they want, whether that's C4 for the Nord Stream pipeline or a dam in Russia operated by the CIA. Sorry, I don't want to get demonetized here. But anyway, continuing. So what else do we know? Well, we know that the Wagner chief has been critical of the Russian military in the past. It just hasn't risen to this level. He's actually made arguments that he was deceived in terms of why Russia was getting into this war in the first place, that they believed this sort of false propaganda set up by Putin. And these are strong words coming from a mercenary leader that could really serve to undermine a lot of Putin's efforts going forward. And a lot of folks suggest that it's going to make it even harder for Putin to continue his charade or his onslaught, especially into new areas. So this is a big blow, massive blow to Russia. We'll end up seeing really at this point what's going to happen to the economy, or I should say to markets as a result of this, is anybody's guess. A lot of folks making references to this as a chessboard, and nobody really knows what move somebody is going to make next. Wheat futures are up about 2% right now at the time of this recording. It's actually a really benign movement in the wheat market. When we saw Russia invade Ukraine, wheat basically doubled, mostly because Ukraine is considered the breadbasket of the world, and any kind of disaster in Ukraine should affect wheat prices. Of course, that ended up being more of a trader, phenomenon than a long run elevated price level for wheat. So, as usual, people like to buy the rumor and sell the news. Although I guess when that was sort of the opposite with you, maybe that's not the right reference. I guess maybe this is more like buy the invasion, sell the war. There. Buy the invasion, sell the war. That's kind of what happened with wheat futures back when Ukraine was invaded. But now wheat's moving 2% and oil's up like 67 bips on the US blend and 74 on the international blend. This is like nothing. The market's kind of like, at least it happened on the weekend. I honestly think that's what the market is thinking. I think the market's like, well, at least we didn't get the volatility spike during the work week, which is like a super like posh and like suity thing to say, as I wear a shirt and tie and a suit jacket. But anyway, that is what some people are arguing. So anywho, this catches you up really just sort of as a broad overview with at least some of the considerations that should be running through your mind about this coup, whether the coup was orchestrated by the CIA or not. There's so much conspiracy. I don't really care. There's so much that goes on. We don't know the answers to everything. You can't rule anything out these days. The point more practically is what we've discussed in this video. So hopefully it's useful for you. And if you like practical insights like this, make sure to join the practical courses on building your wealth link down below. And rather than spending your time watching TikToks or tweets on nonsense on, AI tools, learn how to actually use AI to make money in my productivity and how to make more money course linked down below, both for entrepreneurs or employees. Learn everything about it's not just AI, but it's everything about how to make more money. And then, of course, there's an AI segment. And then we've got the stocks and psych and the real estate 0 to millionaire, as well as the property management course on the investing side that are very, very popular. All of them will face a very large coupon expiration this Friday as we release another massive lecture set for all of these courses. All right. So with that said, thank you for watching the Russia segment. So, okay. Next up. Okay. Martin, do you have like cameras here or something? I don't know what it was, but I probably was in bed for like 2 hours yesterday around midnight. I don't think I got to sleep until 2 a.m., which means I'm probably only on like 2.5 hours over here. But I was in bed somewhere around midnight, and I'm like, yay, I'm gonna get 4.5 hours, and I just couldn't go to sleep for 2 hours. There's too much on my mind. You're right. You read my mind. That's very scary. Who are you and what do you know? What do you want to go away? Someone says they've been looking into India ETFs this past week. Billions being dumped into that economy right now. Yes, because people don't know what to identify in terms of actual alpha and quality companies. So they're just like, just invest in everything. I don't care. I'm not touching India with a 10-foot pole, and that's fine. India could end up having 1,000% returns compared to maybe 100% returns in the same time frame in the United States. But I will stick with my beautiful, sexy, delicious United States stocks, at least for now. I don't know it. I'm not going to pretend to know it, and I'm not interested. Anyway. All right. So, what else? Some funny comments here. Okay. Now, what else do we have? Oh, yes. Okay. Well, there are a couple, there's some cool pieces we could cover here. Yeah, let's do that. So we've got a Wall Street Journal piece and a Bloomberg piece on what to expect for the second half. That could be kind of fun. So we'll go into that. And we'll keep going here. Oh, of course, Mr. iPad. Mr. iPad always wants to sign me out. Oh, but fear not. we would get into there. So let's see what else is news. Well, we'll have to talk catalyst this week too. Big catalyst this week is going to obviously be, you should know it, PCE, right? Personal consumption expenditures. It's going to be a relatively big catalyst for this week, which is also a sign that this week's going to be somewhat boring. I say that in honesty because even if there's volatility this week, we really lack larger catalysts this week. That's the largest that we could really think of this week. I mean, unless there's some form of black swan or something crazy that pops up this week. PCE is data that comes out on Friday. So we'll talk about that soon. And after we go through some catalysts and some other news, we'll take a check back on the markets. But for now, let's jump into these insights, potential insights, the speculation about where the market may go going forward. All right, quick sip of coffee. Oh, man. All right, here we go. Mm-hmm. If you're having coffee, I hope you're enjoying your coffee. If you're having vodka, you're crazy. All right. Okay. We'll call this segment the next half. All right. So the NASDAQ 100 is set to enter the best opening 6 months to a year ever. And a lot of folks are now wondering, what does this mean going forward for the rest of the year? And this is where the Wall Street Journal and Bloomberg have two separate pieces talking exactly about what our expectations might be going forward for the next, well, 6 months. And let me just say this. If you're a bear, don't hold your breath. You actually might really want to take a look at these and question your choices. Although, who knows? Anything can happen. These are just two articles in the wind, and we'll see what kind of evidence they have to judge their credibility. All right, the first one. Where the stock market is headed after a wild first half. And they've got 5 charts. So let's see what we got here. Optimism that the U.S. Central Bank, the Fed, is approaching the end of its tightening has helped transform the technology-heavy gauge, the NASDAQ, from the 2022's market underachiever to the early champion with a surge of 36%. The resurgence has defied skeptics, coming in the face of bank failures, recession fears, and the highest borrowing costs since 2007. But investors stuck with stocks, well, or are coming back to stocks in the sign of all these problems. All right, whatever. So what do we got? So this is here's the index here, the NASDAQ 100. NASDAQ 100 has only existed for a little over 30 years. This is its best first half ever. We've only been close about 3 other times, and all of those times were in the first half of the 1990s. You have this argument now that the bulls are back in control, but this is also something to be taken with a slight grain of salt, because back in 2000 to 2003, we had the S&P rally 20% off of its lows twice, only to create new lower lows. The next chart that the Bloomberg folks want to show us is that the S&P 500 has eclipsed Wall Street strategists' year-end projections. That is also, as some would say, a red flag, as we often get a mean reversion. Consider in COVID right here, we have this massive mean reversion that really took the shape of a V-shaped recovery. You can see the red line is really what analyst expectations are, so market expectations are for an end-of-the-year price target. Those are sitting somewhere around 4,100 on the S&P 500. Right now, you're already at about 4,400, so you've got some downside risk over here. Then you've also got the largest laggers so far this year, consumer discretionaries. Last year's biggest laggards. Yeah, I was looking at that. I'm like, wait a minute, I'm reading this backwards. My fault. Last year's biggest failures are this year's leaders. It's obviously led by tech, communication services, consumer discretionaries. These were the ones that failed last year. They're doing well this year. I actually expected consumer staples to do worse than this. They're only at negative 1%, so they're basically flat. What's actually gotten hit a lot harder so far this year has been energy. Now, I personally think that the mispositioning that we saw for technology in the first 6 months of this year is the same kind of mispositioning that you're seeing created in the solar sector right now. Now, keep in mind, that's just a part of the energy sector, but I really believe that the energy sector, specifically solar, has been completely forgotten. It used to be a hot, sexy trade. Everybody's like, I got to invest in solar. I need my solar ETFs, and I got to get my exposure to panels and panel manufacturers and, even like Array, which manufactures the mounts for panels, or inverter companies, SolarEdge, Enphase, whatever. Even Generac got in the craze with batteries. That bubble popped hard, but I think it's overextended to the point where there probably will be some mean reversion, just like what we saw in tech at the beginning of this year. It'll come for solar. I'm pretty well convinced, especially since we were talking about this in the course member live stream on Friday. We believe, based on some just initial research that we're doing, Solar will probably exceed earnings expectations this year and still grow in the neighborhood of 30 to 40%, which is pretty remarkable. We were talking about some of that research in the Course Member Live on Friday. Remember, you could get lifetime access to that. Link down below. Click that first link there. Go to meetkevin.com. Make sure to join before Friday, as we've got a large and massive price increase, a coupon expiration happening on Friday as we release more lectures this weekend for all of the courses, Stocks and Psych, the Zero to Millionaire Real Estate, and more for the Productivity and AI course, which is very exciting. Anyway, back to this. So what does this mean going forward? Well, a strong first half historically bodes well for investors, says Bloomberg. The S&P 500 returns, or here are the S&P 500 returns, when the benchmark climbs at least 10% through June. So think about that. When you go from Jan 1 to June, and the S&P 500 goes up at least 10%, what tends to happen on average? Well, what you tend to get is, well, spoiler alert, it's an extra 10%. They broke this out part by other years over here, and the average is an extra 10%. I don't know why they didn't write that average on this version of this, but it's a good thing. Usually it bodes to, it leads to another 10% in the second half, which is remarkable, knock on wood. But on average, if the first half is really good, the next 6 months tend to be very good, according to Bloomberg. Now, what does the Wall Street Journal have to say about this? Because they also have a piece. Take a look at the title of this one. This one's kind of exciting too. This bull market is just getting started, traders bet. Everyone wants a piece of the new bull market. Traders are piling into bullish options bets that would profit if the recent stock rally continues. And so this is where I would also just like to throw in a little bit of a two-sided heads up. One heads up is that we're probably in a position where a pullback would be healthy. Some form of modest pullback would be very healthy and expected at this point. That's a big deal. So think about that, because if you have a pullback, which usually you do, the S&P 500 usually sells off by 3 to 5%, somewhere around every 2 to 3 months. And I'm not just making that up. In fact, Deutsche Bank had a piece literally saying that. Here is that piece. I like to show you my sources. Right here. Modest sell-off, now arguably overdue. The S&P 500 sells off by 3 to 5% on average every 2 to 3 months. Now at over 3 months, since the last meaningful sell-off in March, the duration rally is in the 85th percentile, and a sell-off is now arguably overdue. Okay, so what does that mean? Well, what that means is if you're betting on options right now, one thing to keep in mind is, especially if you have near-term dated options, you're probably going to paper hand them in a near-term sell-off. So there's a high risk of paper handing if you hold short-term options going into a potential near-term pullback. Okay, keep that in mind. Now, another thing for options is volatility right now, epically low. Now, that's great. Now, you already know this if you've taken the Stocks and Psych course. But what do you want to do with volatility when it comes to options? Surprise, surprise. It's the same thing. It's buy low, sell high. In other words, you generally do want to buy options when volatility is very low. Every time you buy options, you should be looking at stocks. These are some of the new lectures that we're going to have coming out, new additional lectures, since we already cover a lot of this. But we'll have more lectures on this coming out this weekend. But one of the reasons you want to buy with low volatility is because your options premiums on call options are a lot lower, or even put options. They're a lot lower than when volatility is high. It's because of the Black-Scholes model for pricing options. It's just the way it is. Volatility is one of the factors of pricing. And you generally want to sell when volatility is high. So what you want to do is make sure you are evaluating what the volatility levels are of stocks that you're considering investing in or not investing in right now. And so you should be looking every time you think about doing options at a particular stock and saying, okay, what's my volatility been over the last 30 days? How does that compare to the last year? And am I buying at a relative high or a relative low? and that'll help you understand whether you should buy or sell. Point of that is if we do have some sort of near-term pullback and there is potentially any kind of short-term volatility increase, there could be some potential benefits and risks depending on which options you align with. I guess the warning here is be prepared for some form of shorter-term pullback before we get more rallying. Now, in my opinion, that actually tends to leave people trading a lot more than they buy and hold. That is when you expose yourself to options, which is what the Wall Street Journal is talking about here, is that people are making many more bets on calls. The put call ratio, which is the level of puts to calls, puts on top, is now at a 13-month low. 13-month low implies people are finally really going back to shopping calls, shorting the market less via puts. And as we see here, traders are piling into bullish options bets, especially driven by AI and tech. You should be careful if you are one of those traders making those bets because you're more likely to trade. Problem with trading is that you're not going to huddle, so you're exposing yourself to those taxes. And if you get flushed out and then you get the real rally, you might end up missing the boat. That's that's probably the most frustrating part about options. Now you can play that. You can play, certain strategies for options. So if you really know what you're doing, you can play it just well. Just obviously be aware of some of these risks. This particular Wall Street Journal article is a little bit more surface level when it comes to options. But take a look at this. Chip stocks, average daily call options volume. We're at the highest level that we've seen since basically the beginning of the pandemic. And we even beat the call option frenzy of 2021 in chip stocks, which is pretty remarkable that we've beat that for really the last 2 months in a row here. And then if you look at this particular chart here, call options volume tied to the S&P 500. Even these in 2023, starting actually in about November of 2022, which was a perfect time to do it, you've seen call option bets really skyrocket. So pretty impressive, but also a risk factor nearer term. I think that's some of the beauty about owning maybe in the money options or longer term or just the shares is you don't have to worry so much about those individual fluctuations, mostly because I think some folks are under the impression of, oh, you buy an option like 45 days out, which is usually a pretty profitable time to buy options. And your goal is to try to make a lot of your money within the first 21 days, usually if you're buying. But anyway, if you go through a week of red or 2 weeks of red, and you're now 2 weeks into your 45-day options, you're at 30, you've got another 9 days for your strategy to play out. After weekends, it's like, you start getting a little nervous. So in other words, be careful. Now, the good news is longer term, these pieces are pretty bullish, and we are seeing inflows that are pretty strong into the market. Go back to Deutsche Bank for a moment and consider this. Right now, you have a discretionary investor positioning slightly down, especially as we've seen some money taken out of exchange-traded funds and tech over this last week following 13 weeks of inflows. What do we have? We're actually only about a quarter of one standard deviation above the average for positioning right now. So we've seen this shift recently, sort of like a Z-score measure. Ignore all that crap. Point is, we're starting to trend back to being more bullish on the market, going towards overweight. Most investment advisors are actually still underweight. Now that's a separation, right? This right here talks about investors themselves, retail, and then institutional investors and your fund managers still about 32% underweight the market, which is really incredible. So something else to keep in mind. Now, as far as markets overall, in Deutsche Bank's opinion, they think that most of the discretionary positioning right now, so retail investors choosing where to be with their stocks, most of it is geared towards the reality of a soft landing. So if we don't get a soft landing, it's going to hurt. But I think a lot of us are quite well aware of that. It also seems like we'll have some form of a muted reaction from this mutiny in Russia. And bigger catalysts will really be how long is higher for longer. Although, quite frankly, even that, I'm not sure if that's the real catalyst markets care about right now. And it seems more like markets care about what's going to end up happening with earnings. Will earnings beat or will earnings miss? I mean, the terminal Fed funds rate right now is projected to sit at, let's see here, let's grab it here, and then let's look at the 5-year break even as well. So terminal Fed funds rate right now still sitting at 5.29. That's only slightly pricing in one more rate hike. That's really not a big deal. You also have, let's see here, you've also got the 5-year break even. 5-year break even, very well anchored, down to 2.16. That's actually pretty good. It'd be nice if it were falling. Really, you might have to end up getting another rate hike from the Fed to get this to push down. Markets are now seeing the terminal rate as of today, terminal rate being priced in for November. And then your first cuts pricing in for March, with probably a full percentage points of cuts priced in for November of 2024. Of course, that pricing metric could change, and we'll see how earnings hold up between now and then. But so far, there don't seem to be horrible red flags from the mutiny, don't seem to be horrible red flags from oil or energy, no horrible red flags from commodities, no horrible red flags on inflation. We do have an inflation catalyst this week, PCE coming out on Friday. We'll talk more about that later. But beyond that, this is, I'm very curious to see how the week starts off here. Came off a little bit of a rough 4-day week last week. And fingers crossed we have a little bit of a stronger one here. But again, any kind of near-term pullback, totally expected with the rally that we've seen so far. So don't get nervous. I personally am all in. Yeah, I know that makes me biased, but I'm looking at the bear arguments every single day, and nothing scares me. And just like in January of 2022, when I put all the pieces of the bear puzzle together, everybody knew. The entire world knew within 24 hours. Like, oh my God, this is a poop show. And I will always be the first to let you know when I change my mind. As much as there are going to be some people who hate me for changing my mind, I'll always change my mind. After all, I am wearing the suit and sitting without pants on with a Hello Kitty coffee mug. So then again, consider the source, I suppose. Oh, we got to cover a Tesla piece next. So anyway, that's that. All right. So, yeah, I feel like crap. All right. Let's see here. Okay. What does CNBC have for us? And then I want to get to talking about Tesla in a little bit too. Let's see if I can get this working. All right. Let's see here.
Junk fees, about getting rid of non-compete clauses, about making sure, about doing all we can to hold down energy costs, which remain about $1.40 below their peak in last summer. So it's yes, people care a lot about inflation, but it is not the only thing they care about. I think you're wrong about that, Joe.
Well, I was just trying to help you explain why his economic approval is 35%, and it's just not
Ask
because
people about the specifics. You got a microphone. Ask people about the specifics and see what they say, and get me back here to talk about it with you.
All right, Jared.
Thank you.
I'll thank you, Jared. Andrew, I can see Andrew thanking you. We all thank you.
We're all thanking you.
Jared,
This guy does not like the Biden administration. And the guy on the right is obviously from the Biden admin. Can you make a video or a short on the pros and cons of owning a real estate in a Roth? It's a horrible idea. Don't buy real estate in a Roth. Do not buy real estate in a Roth. Do not buy real estate in a Roth. Not personal financial advice, but don't buy real estate in a Roth. Why? Because you lose the benefits of leverage, the sweet, sexy leverage, the juicy 3-5% down that you could be buying real estate in. Why do you want to buy real estate in a Roth? What you should be doing, broad advice here, not to be confused with personal financial advice. What you should be doing is very simple. should be taking your money, throwing it into a Roth, max that sucker out every single year. Realize then that you could take your principal out at any point and buy real estate because you already paid taxes on that principal. So you can take that principal out penalty free, confirm with your CPA. You take that money out penalty free, use it as a down payment on a home. That down payment should then give you leverage in real estate. But buying real estate in a retirement account is nonsense. Unless you want to go buy in a bankrupt town where prices for homes are $20,000 to $50,000, and in 20 years, nobody's going to be living in that ghost town anymore, and you're going to be like, wow, why did my real estate not appreciate? Unless you want to buy garbage real estate. Don't buy real estate in a Roth. Be an American and go lever up. There's your $10 answer. Thanks for the donation, by the way. Okay. Right. All right. So I had something I was gonna talk about. Somebody said brace for impact. End phase, this massive pull. End phase has a risk of going to 120. I thought the 165 level was going to be a floor. We're under that floor right now. It could go to 120. But this is right here. Keep this in mind. Right here is where Enphase was buying back stock like crazy last year. In my opinion, just one of many indicators suggesting this is a great place to be. Like, look, I get it. I obviously have an Enphase position. When we looked at it at 300, we're like, this is way too rich. It's going to correct with the housing market. It did. I thought it would stop at, 180. I didn't think it would get to 185 or 165. 165 was sort of like, okay, that's a great number if we get there. We got there, and now we're at 155. And it's like, oh, I think you have the rubber band is being pulled very much to the opposite direction for solar right now. I really expect a flip-flop. Obviously, I can't guarantee it, but I think markets will go, oh, solar is under position. Let's allocate over there. And when that becomes sexy again and it all rallies, people are going to be like, damn it, I wish I bought more solar. It's just tough because it's painful at these times, right? Today's thought of the day, go lever up. There you go. Yeah, that'll be sure to bother some people on TikTok. Okay. I guess we should probably talk about Tesla, huh? Tesla. Yeah, we'll talk about Tesla. We got another downgrade for Tesla. So we'll talk Tesla. Tesla. So let's see here. All right. Let me grab one thing here because there's some drama going on. Okay. Actually, there's a lot of drama going on. Jeez, Lord. Okay. Hold on. Where is it? Oh, wow. She's going off. That's crazy. Oh, boy. Okay. All right. Tesla. Yes, Steve. That's exactly literally what we're going to talk about. Yes, Andrew. All right. Sorry. Sometimes it takes me a moment to transition. Today, it's taking me a little bit of a longer moment. Sorry. Okay. Tesla. Well, we got to talk about my homie, Ross Gerber. Oh, Ross. I screwed that up. Hold on. I gotta do that again. I can't even say his name. I'm sorry. I need another sip of coffee. I'm dying on the inside. I'm really glad to be here. I actually really enjoy doing this. I just feel bad. The good news is I don't feel badly. Have you ever wondered the difference? Like my sense of feeling, the fingers feel fine. I'm sorry. I'm just trying to distract you so I could drink more coffee. All right, let's try that again. Oh, boy. All right. You know what? We needed the music. Well, my boy Ross Gerber is back at it again, making headlines. Last time it was for wanting to challenge the Tesla board of directors and run for a seat on the board at Tesla. This time around, it's not being spun as the best news that Ross Gerber has gotten himself into. Ross Gerber visited Dan O'Dodd. Dan O'Dodd. If only you knew Dan O'Dodd. Dan O'Dodd is a dude who's run this technology company, a legacy style technology company that's created software that has been used by the likes of the government and in ADAS software, and essentially runs a company that provides software that competes to some extent with Tesla's full self-driving. And Dan O'Dodd has made it his mission to be critical of FSD and Elon Musk and Tesla, even though allegedly he owns an original Tesla Roadster, though it's worth noting the original Tesla Roadster, which I also once owned, doesn't have any FSD. It's just a dressed up Lotus Elise with a battery pack in it. So what do we have with Dan O'Dodd and Ross Gerber? And did we just get another price a downgrade from another Wall Street bank? Yes. In fact, we'll talk about both Morgan Stanley's downgrade for Tesla and Goldman Sachs' downgrade for Tesla in just a moment. But first, we have to look at something that unfortunately is not so great. Now, I'm going to give my commentary on this and my suspicions on this. I live approximately 40 minutes away from where this incident occurred. So when I feel better, I will visit this area and conduct my own sort of research and investigation into this. But I will tell you, upon first viewing this clip, I was very disappointed well, I'll give you my commentary after I play it. So let's go ahead and play this clip, which is unfortunate because I want to say that I truly believe in my heart Ross Gerber went to visit Dan O'Dodd to show Dan O'Dodd the light, to show Dan O'Dodd how great full self-driving has become and how far it's gone. The problem is, and this is what happens when you enter the pig pen, so to speak. You know, when they say, what's the saying? When you wrestle with pigs, you get muddy or you get poop all over yourself. This isn't to say that anybody's a pig particularly. It's just to say when you wrestle with haters, you know, you say one thing wrong and 99 things correctly, people will only elevate the one thing that was wrong. And Ross Gerber had a sit-down interview with this gentleman. I think people should listen to it. And he spent an hour driving on FSD in Santa Barbara in almost a perfect manner, with the exception of this one clip. And this one clip is the only thing the internet cares about. Of course it is, because that's how the internet works. But anyway, anybody who actually uses FSD knows whole well that FSD is not perfect. You have to pay attention, especially at those edge case scenarios. If you are a Tesla owner, you know where those edge cases are. I get onto certain highways. I'm like, the car makes me a little uncomfortable here. I take over. I get to certain intersections. I'm like, I'm going to take over in these areas. The more people feel uncomfortable in those areas, though, ironically, the less the car is able to train itself in those areas. But then again, people don't want to actually crash, right? So anyway, I'm going to show a clip which doesn't look very good. There is context missing, though, substantial context missing from this clip when you see it. And I think it's worth actually seeing another clip before this, just as sort of a preview and my response to Omar on Twitter. He's always posting excellent commentary on Tesla. And that was right here. He says, yesterday I had to take over to prevent my Tesla from running a red light due to a weirdly angled traffic light. It responded to the wrong light. Basically, over here on the right, the light turns green and the car starts moving for Omar's interaction. There it is right here. But he's actually got a red. There it is. This one versus this one. Anyway, I commented right here. I said, humans make this mistake daily. Ever sit in a left turn? Excuse me. Oh, gosh. Ever sit in a left turn and see the right/straight lanes hit the gas when the left turns green? If you're a driver, you know that feeling. You've probably done it yourself because humans do that all the time. And so what I wrote is FSD will eventually not make that mistake, but humans will always make that mistake. That's why full self-driving is seen as at least 2.5, if not 10 times as safe as a human driver without any ADAS. So with that said, and with the prefaces out of the way, and yes, you can't remove all of your biases. Everybody knows that. Everybody knows I'm a Tesla investor. Tesla's, it's in my fund. It's exposed personally, and all of that, right? But I always like to look at things objectively. And I have to say, when I first watched this video, I was very disappointed. But I'll show some context afterwards. So let's go ahead and start. Well, we're not really starting anymore, but let's get into the actual clippity-doodly data here.
No, she's not a real deadhead. She's never seen the dead. All right, here we go. We're going to get killed by this guy.
It's on FSD.
Now, in real life, I would not wait for this. All right. I disengaged. Yeah.
Elon took
Yeah.
over.
See, I would have just gone by
Ross took over.
that. It hesitated, then it decided to go by it, and then it was like, no.
This is a problem.
But, oh. There we go.
That was you breaking?
I braked.
Yeah. It didn't crash.
I wasn't going to wait and find out because I saw the two cars going at each other, so I wasn't going to test that one.
Okay, so that was obviously not a very good look. Now we can break this down right here. There's been a lot of speculation around this. Oh my gosh, I'm sorry. Before we break this down, you need to see context. The context that was very, very important, that is highly missing from this video. Highly missing from this video. And you should not go a second further without this context. Is this. Look at where the stop sign is actually positioned. The stop sign is actually positioned about 20 feet, at least a car length, if not 25 feet from the stop line. The problem with this, and I will tell you, in these old neighborhoods, especially in Santa Barbara, this is a problem. The problem with this is I'm going to use this star to simulate a driver, okay, coming from the other side. A normal driver sees nobody at the stop line, which is right here, right? And what does a normal driver do? They cut that line. Everyone cuts the freaking line on a left turn. That's humans. Everybody does that. I'm not making excuses, just saying that's what humans do. You're supposed to drive out and then make your left. But people don't do that, okay? People don't do this because it takes more effort. They're just going, yeet. Okay? So, understanding that about humans is very important. 1. 2, understanding the distance of this stop sign from the actual stop line. Very important. Next, what else is very important to understand? After we pass this vehicle here that Ross dodged, after we pass this vehicle, you could see Ross take over, and then he adjusts the wheel right here by scrolling up. This is a way of telling the car to go faster, right? And Ross doesn't live in this area, so he doesn't know about this stop sign coming up. Dan probably does. There you go. You can see autopilot getting engaged, and the car set. It looks like it's set to a little bit faster than where we're going now. Yep. In fact, if you look very closely right here, you can see the 38. Then you'll see Ross's thumb roll up, pushes it to 40. The number on the right of the actual speed limit is, or the speed the car is going, is the top speed you're trying to set the car at. So you can see it got set to 40. He lets go. That leads the car to accelerate. What frustrated me is that the car should not be accelerating here. This was a problem for Tesla. I did not like this. When I saw it, even before the stop sign, I looked at this and I said, no. The car should not be accelerating here. The car does this It happens sometimes, and I admit that. As an FSD driver, I am acutely aware of that. And I am acutely aware that in curves, in turns, Tesla will often turn late in certain areas. Now, don't take that out of context. It will not always turn late often in certain areas. It will just repeatedly make the same mistake, right? And it gets better and better and better. I'll give you an example. There's a lemon factory and then a railroad track and then a sharp turn. The recommended speed limit for that turn is 30 miles an hour. 3 years ago, my car would take that at 55, and then not until after the turn, and it was like basically out of its lane, realize it screwed up. Today, it slows to about 42, doesn't leave the lane anymore. That's pretty much more that's a lot closer to a human driver. I'd probably take that turn in about 38. So it's still a little on edge, but it's gotten substantially better. So if 38 is ideal, it used to do 50, and now it's at 42, it's getting better. But this stuff takes time, right? Obviously, it takes time. But I will say, when I first watched this video, I cringed because I'm like, no, the car should not be accelerating here. And this is not, in my opinion, and I don't know, but there are a lot of people speculating on the internet that are saying, oh, well, Ross's foot is on the gas pedal, and they're taking screenshots of Ross's foot or whatever. I don't believe that. I believe that, not to say that he's accelerating. I believe that to say that a lot of FSD drivers leave their foot where the car is acting. So if the car is driving, you hover your foot over the gas. The reason people do that is a lot of people put their feet just flat on the floor, but that's not, in my opinion, as deal because it actually slows your reaction speed to get to the brake. I mean, just imagine it for a sec. Wheel, if your foot's hovering over the gas, it's a lot easier for you to step on the brake and move over because you don't have to lift your foot and then hit the brake. You just move over and step, right? It's like it's one motion as opposed to two motions. Well, think about it. A stomp is like a lift and a step, whereas the move over and brake is kind of like one fell swoop, right? So a lot of FSD drivers actually do hover their feet over whatever the action of the vehicle is or is supposed to be at that time. So like if I'm coming up to a red light, I take my foot off the gas, I hover it over the brake. So that way, if the car were to screw up or whatever, I brake. That's the point. You're still paying attention to some extent, right? It takes the whole point of FSD, at least at this point, in my opinion, with how few disengagements it has now, the whole point is to take a lot of that stress off of driving and really to be an assistant, to be a partner to your driving. Eventually, it'll just completely take over. And to many regards, it already has. But anyway, then so I don't think Ross is hitting the gas here. This is the car accelerating. So you see this right here going from 33 and up. This is the car accelerating. Now, Ross actually, and this in my opinion is why Ross is not accelerating, is he feels the car is going fast. He feels the car going fast here. He knows he's coming up on a stop sign, and the car is accelerating. Watch Ross scroll down on this wheel. You're actually going to see that 40, the limit for the car, go down to about 38, 37. There's the scroll down. He actually takes it down to about 35. Now we see the stop sign, and you'll see Ross grab the wheel a little more firmly there with his right hand, whereas previously he wasn't holding. Now he's like, uh-oh, I might have to take over. I'm going to hold the wheel here. Keep in mind, there's the stop line about 25 feet after the stop sign. Now, remember what I said about when people turn, they cut that line. I promise you this car is cutting that line, at least from what I see. That car is positioned almost perfectly to cut right over that S and the T of this. Now, it's hard to tell perfectly, but that car is not expecting a car to be at the stop line. If Ross were at that stop line, that car would have come out straight much more than it did. Look at the gap between this vehicle and this vehicle. These vehicles, see where this car stopped on the other side, right? See the car on the far side stopped, right? These cars should have virtually no gap between them. There's almost enough of a gap between those cars that you could fit a third car in between those two left-turning cars. And to picture that for a moment, on a narrow intersection like this, There should be no gap because everybody should be taking the turn appropriately. Let me draw that for you really quickly. So if I draw the intersection like this, oh my gosh, this reminds me of Police Explorer days. If we're going to go from this lane, and assuming there's a car at the stop sign, we actually make the correct bow. Let's use purple here. We should be having some kind of turn like this. And then you should be able to have another car at the same time do some kind of turn like this, right? There shouldn't be much of a gap between those two vehicles right here. There shouldn't be much of a gap. But because that white SUV took more of this approach, and then you kind of see them like course correct here because they see Ross come up, you actually get this look. Look at this. They turned more, and then they kind of straighten early and actually turn their wheels to the right. See, wheels turned left, turn their wheels to the right a little bit to avoid Ross because they were cutting him off. Worth noting. Now, sorry. I was supposed to switch back here. Yeah. Look at the wheels turn here. The wheels are ready to cut the line off. And then you could see the car's wheels turn somewhat to the right and straighten out there. So, is this an excuse for FSD? No. FSD screwed up. It went to that stop sign too fast. Absolutely a screw up. It should not have approached the stop sign that quickly. Absolutely not. I can't forgive what the FSD did there. Even though that stop line is 25 feet behind that stop sign, that was a mistake. The car went too fast. I believe it would have stopped, but I would have taken over as well. So fair takeover. The car was going too fast. Ross realized it as well. That's why he scrolled the wheel back and slowed down. But unfortunately, the optics of that clip do not show you all of the context. Now, we need to get into Morgan Stanley. We need to get into the Goldman Sachs downgrades. But first, it's quickly worth looking at some of the drama. Ross says, I will ask you nicely once to remove and discontinue false advertising that includes my image and likeness without my permission. Thanks, real Dan O'Dodd. Dan O'Dodd should have gotten a release signed by Ross before before putting this out there. But anyway, so Dan O'Dodd replies, then what will you do? Ask me not nicely, or will you demand a cage match? Anyway, Dan O'Dodd's going off on Twitter. He's, screaming, this video confirms Tesla full self-driving runs a stop sign. Your quick reaction saved us. Remember, the problem with the stop sign is the stop line is not visible in the video. And so it's a great opportunity for everybody to sort of bag on Tesla here. And it's unfortunately for Ross making the mainstream news. I think the Daily Mail was covering this with FSD and some other mainstream news agencies were blaming this FSD failure or whatever. So expect more drama about this. Again, with context, I think it's a little bit more understanding, but I personally think the car was just going too fast. That's my take. So what else do we have here? Steve, no, like, and then I want to get into this commentary here specifically about the downgrades. But no, Steve, of course you're going to course correct slightly to the right. But the point is, they would have. It's not like they swerved to the right. They were cutting off that stop sign. I don't think there's a question. They didn't see a vehicle there. So, of course, they didn't leave enough room, that SUV. I'm not saying the SUV is at fault here. I'm just saying it was a contributor to why the video looked the way it did. That's it. The Tesla does not acknowledge where the stop sign is, and you have to know that about the software. For example, somebody here says, when Tesla passed the stop sign ahead, it should have slowed down. I agree with you. I don't actually think it fully pays attention to those signs as much as it should. Just like it doesn't pay attention to the recommended speed in a turns lines. At least I don't think it does. Not in my experience. So I agree with you. But Teslas are looking for the stop line. And that's probably a problem. And I agree with you. It was going too fast there. So don't get me wrong. I agree with you. I agree with you that Tesla was going too fast. I want to make that clear. Now, let's get into some of these downgrades. So last week we had a Morgan Stanley downgrade. And going into today, we are getting a Goldman Sachs downgrade. Let's start with Goldman Sachs. GSACS. GSACS right here is inviting you. They're not, but I'm pretending they are. To check out the beautiful, sexy courses on building your wealth link down below with an expiration of the sexy coupon code on Friday. Prices will be going up because I'm releasing more lectures this weekend. And so we'll have a big coupon expiration again. My goal is always to just continue rewarding the existing course members. All right. So what do we have here? Tesla, downgrade to neutral with stock now better reflecting our positive long-term view. So usually what happens is these analysts frequently, I shouldn't maybe say usually, but frequently, the stock goes up, everybody upgrades the stock. The stock starts ticking down, they all downgrade to neutral. Stock goes down longer, they all go bearish. It seems like they follow price action. I don't know if it's the chicken or the egg, but let's look at what they're saying because it actually isn't that bearish. We think the market is now giving the stock more credit for longer term opportunities. We think there has been less price discounting from Tesla than investors feared for Q2. And vehicle inventories seem to be falling faster in Q2 than expected. In fact, I do want to say my Tesla referral code, when you go to metkevin.com/Tesla, it's jumped like 20%. It was like 98. Oh, more than that. It was like 98, and now it's at 127 Tesla referrals. So I think I made like 30 Tesla referrals in the last, I don't know, 30 days. It's kind of nuts. I can buy some more Tesla short shorts, or I could get like some Tesla models, which check this out. Speaking of model, I have not shown this off yet. Look what came in the mail. I didn't pay for this. I bet this was expensive, but this was given to me by the person who sold me my plane, and it's a really cool gift. It is a custom model of the exact plane and the exact. I can't really get my camera to focus on it. Exact plane and exact paint scheme of my plane. How cool is that? It's even got my future new tail number on it. 69 4 PP. It's pretty cool. I love this thing. My kids are like, Daddy, let me play with it. I'm like, no, this is my toy plane. Mostly because Max, quick tangent. Max takes the planes and he's like, look, Daddy. I'm like, no. Anyway. Okay, so where were we? No, we still expect pricing to decline in the second half of 2023 as supply and demand come into more of a balance, says Goldman Sachs. But we are seeing more of an inventory sell-through in Q2 and less pricing pain than we expected, is what Goldman is suggesting here. They do suggest that the charging network and FSD will be limited near-term contributors to earnings per share, but more long-term beneficiaries for the stock. And they suggest that Tesla is well-positioned for long-term growth. I always think it's crazy that when you have these companies, these analysts are like, oh, this is a company that's positioned for long-term growth. And then they downgrade the stock. It's crazy. Anyway, third generation platform. Oh, right. These are the next catalysts, right? So they touch on Gen 3, your 50% vehicle cost reduction, trying to get to that $25,000 car, the Cybertruck. Oh my gosh. Have you seen the Cybertruck videos that have been circulating? If you haven't seen the Cybertruck videos, you're about to see the Cybertruck videos because they're showing the Cybertruck with the freaking rear wheel rotating. And I'm like, I thought that was going to be clickbait. Not only moves like 10%, but this is like straight up Warthog. If anybody played Halo, and I'm talking the original, I'm talking OG, okay? I'm like Halo 1, Combat Evolved, baby. the enemy has captured Captain Keys and they're holding him aboard an enemy, whatever. Anyway, the Warthog's wheels turn in the back to help you make a turn. And this was remarkable to me. Just watch. The back wheel turns slightly as they make this tight turn. It's like, oh my gosh. See, the back wheel's turning out as the front wheel is turning right to tighten the turn radius. It's amazing. Amazing. So anyway, back to where we were. Goldman Sachs EPS for this next cycle, not good. It's only at 275. The market has Tesla at 350 right now. And then you get to about roughly in line. So these are in line. This is very low. Very, very low. And they acknowledge that. I mean, they say slightly below. I'm like, no, like 15 to 20% below. It's not slightly, in my opinion, but whatever. They believe that Q2 deliveries are doing well, tracking for 445 to 450. The Tesla cars are awesome. They have efficiency. This opening the charging network is just going to actually help Tesla not only expand the pie of charging revenue, but create more charging stations. They did say that part of the reason for their downgrade, was that AMD and NVIDIA are now trading for 42 and 55 times the next 12 months earnings, and Tesla's sitting at 93 times. I think if you use the correct EPS, it's not that bad. But yes, all of these companies have gotten significantly more expensive. They were all under a 1.5 peg when I bought the crap out of them at the end of last year. Now, they're all above a 2 peg again. Peg is PE divided by growth. Anyway, expected growth. So, what about Morgan Stanley? Well, Morgan Stanley's got a piece too. But Morgan Stanley's always got a piece. Is that inappropriate? Anyway, so I just need to find it. Oh, oopsies. I put it on my other iPad. I have it. I'll have it in just one second. So, oh, here we go. So the Morgan Stanley downgrade was last week, end of last week. It's right here. So they have a price target of 250. They are moving to an equal weight. Their bull case is actually 450. 450 on the bull case. $90 on the bear case. So then we have, I did not see this 111% year-to-date rally coming, says Morgan Stanley. While the team has defended Tesla as an overweight rating, they didn't expect this. We are not trying to call the end of the Tesla rally. So in other words, they're just trying to say, like, we're not trying to be the bears here, okay? They actually call it a must-own stock in any EV portfolio. Quite frankly, I think it should be a must-own stock in any portfolio. Let me be clear for the regulators watching. I respect you. This is not personalized financial advice. This is broad market commentary. Anyway, some investors may feel inclined to play the positive momentum. We believe the stock upside from here must come, despite our view of continued downside skew. Basically, they're saying, look, you've got some near-term technical risks for the stock, probably contributing to their downgrade, but longer term, in their bullish scenario, it's you have to own it. And of course, they talk about TBD, how the autonomous section of AI for Tesla FSD will play out. But take a look at this. This I thought was interesting. Despite the recent rally, we expect material negative revisions for Tesla consensus earnings forecasts and continue to expect a long-term trend of price decreases and average price declines at Tesla, driven by intensifying competition with Chinese EV players and slowing consumer auto purchases. So, Goldman said this as well. And what does Kevin say? Well, this isn't to say that Kevin knows everything. I definitely don't. I'm just saying, I think Tesla will go free cash flow negative and might have to raise money. Okay? I've said it before. I'll say it again. It doesn't make me a bear, but I do think there's a risk that there will be an offering of either shares, convertibles, some new debt financing. They've got way too many gigafactories building at the same time right now, with even more announcements coming. You got the expansion in Nevada, Northeast Mexico, Berlin, Texas. It's going to be very expensive. Anyway, so they're questioning, have we gone through the worst of it for Tesla? Do we still have some potential headwinds? I think we absolutely have headwinds. I actually think, though, that those are the remaining headwinds. So I want to be clear. If Tesla is, let's say, all right, you ready for this? And let's say over here, this is like a nasty, swampy, nasty, mosquito-filled marsh, okay? And the beautiful heavenly maiden and the sexy valley is over here this way, in that direction over there. You know, we're probably like right there, and there's still a bog monster right here. The bog monster is like, come into my pit. So in other words, you still have to get through this short-term negativity, which could be what I just said: an offering, negative free cash flow, a margin decline. These are all short-term. We know that Tesla is going to survive this. Obviously, we highly expect that. Like, we know that Tesla will make it here, past the bog monster. We know Tesla's going to make it there. We just don't know what this transition is like. Is it like this? Is it like we're going to skip over the bog monster? We're going to go through the bog monster, or we're going to get bogged and then come out? Who knows? But once we get through that, the light's already there. It's just a matter of getting through that. My take: stay away from the bog monster. Don't yell at me if there's a short-term correction. But of course, if it rallies, it was completely my doing. Just like when we convinced Elon to advertise and started the longest Tesla rally ever. Patting myself on the back. I did that. I'm taking all credit for it. Screw you. Okay, anyway. So the rise of Chinese OEMs. Look, China's entire economy is slowing down. So, I do think there's a risk factor in China. There's a real risk in China, and Tesla does sell a lot of vehicles in China. Although we know that the Giga Shanghai is a big export market, it'd still be nice to sell them locally. It'll keep margins propped up. And so you do have some risks over here. Okay, cool. So what else do we have here? Tesla has been losing share in China since the peak of 2020. Losing share to who? Wait, I'm sorry. We have to fix the grammar. Losing share to whom? And that would actually be BYD. Remember, folks, okay? If the answer is to him, then it's whom. If it is to he, then it is who. Sorry. Anyway, yeah, I mean, BYD is obviously your killer over there, mostly because the hybrids are incredibly affordable. BYD's pure EV sales were declining relative to Tesla in Q1, but their hybrids are just so affordable, and with the crushed economy over there, it for some people, it just doesn't make the sense to make that leap to pure EV right now. Anyway, we think that Tesla might have been caught up in the AI multiple premium, given the recent wave of interest surrounding technology. Excuse me, where's the talk about Tesla being willing to advertise and that being the catalyst? What is this? This is like ChatGPT trying to convince me the other day that Chris Hansen was the person who convinced Elon Musk to advertise. I chatted back to it. I'm like, WTF? Chris Hansen wasn't even there. And it's like, oh, my apologies. It was actually YouTuber Kevin Paffrath. Anyway, bear case here. They include Tesla Mobility at $0. Bear case is only 5.5 million units by 2030. 5.5 million units is like my expectation for like 2020. A little earlier than that, a few years earlier than that. Base case for them is actually 7.9 million units by 2030. And then they actually give them 10 million units by 2030 on the bull case, although you'll get some like Elon aiming for 20 million units. We shall see. That Cybertruck might be a big hit. I'm excited about it. I mean, the more I see about the Cybertruck, the more excited I get about it. That's for sure. So, yeah, that's what I've got for the Tesla update. I'm gonna go play with my pee-pee now. Here I go. Look at that. I'm gonna end up dropping it. It'll shatter then. Actually, I think this is made out of carbon fiber. You know what else is made out of carbon fiber? Oh, too soon to make comparisons. Gave me a little bit of a sinking feeling. All right, we should talk about something else now. My heart goes out to the people who lost their lives from Ocean Gate. Also, did you see there was a YouTuber who was about to go on that thing? And the YouTuber, actually, I took a screenshot of it. He showed what it was like getting into the sub because he did sort of a test load onto it. And I'm like, oh my gosh, look at look at the damage that you could see to the carbon fiber hull. I'm like, you can't damage carbon fiber. Carbon fiber is so weak that's what ends up destroying it. And then that's how you get a catastrophic implosion. I'll show you in just one moment here. There's this photo right here. Nope, that's not the right one. Dang it, Kevin. Did I airdrop the wrong one? I did. You idiot. You idiot. Grab the right photo, drag the right photo onto your iPad. Here it is. No, not Mr. Beast. He declined. Look at the damage to the front of the hull there on the right side. I mean, I'm no carbon fiber expert, but let's just say that kind of stuff does not look safe for a carbon fiber shell. Just saying. Just saying. So, with that said, thank you for watching my update on Tesla. Make sure to check out the programs on Building Your Wealth, link down below. And if you need life insurance, just go to metkevin.com/life, where you can Apple Pay and Android Pay and sign up within as little as 5 minutes. That's a paid promotion. Just like how I'm recording this video with StreamYard, metkevin.com/StreamYard. You want 12 free stocks? Go to metkevin.com/free, because they're free. All paid promotions. Link down below. All right. What else? End caps for titanium hull was carbon fiber. Okay, maybe. And if that's the case, it just makes you wonder, though, if there's that damage to the front and they're talking about getting stuck in a ghost net, which is like a lost fishing net, and potential damage to the unit. If that's what you got in the front, is it possible you're getting some of this on the side? I don't know. They were yoinking ropes onto the darn thing. You shouldn't be throwing anything on carbon fiber, I feel like. Anyway, so let's go back to see what the market is doing. All right. So, yeah, I did see what James Cameron said. Okay. So, well, I don't know that. I mean, there were these underwater sonar beacons that heard what could have been a catastrophic implosion. I think it wasn't confirmed until they found the debris, but they knew exactly where to go, right? Wood screws is how the monitor was screwed into the carbon fiber hull. Oh, screwing into the carbon fiber. I mean, all those things just sound bad. Oh, where'd you hear that? Wood screws? I'll look that up. I'll look at that later. So anyway, all right. So what's next? Well, let's see here. Well, we could listen to Sarah Eisen. That's always fun.
Saying that they're not as much powerful tailwinds as they have been over the past few months of the year. No longer the case. They also, and just keep an eye on this, it's what happens toward the end of the quarter and the month, some rebalancing, and it's significant this go around from pensions. In other words, money flowing out of stocks into treasuries to try to square up. So we could see some of that action. Goldman Sachs model estimates 27 billion of U.S. equities to sell for month and quarter end from pensions.
Dude.
So that could happen. But fundamentally, it's kind of a light data week. We get the PC.
Sarah Eisen is wearing Zamrock trim today. You see the red trim around the blue? She's got Zammy trim. Old school RuneScape shout out. Let's go.
It's a very big privilege.
It is. Listen, we can't. We can kid about it, promoting it, but it should be promoted endlessly because it's such an important sit down. And as you've made the point, they're not all fully aligned here in terms of what they're doing, right?
Certainly on the speed. They all kind of lean
right.
hawkish, not except for BOJ. BOJ and China are in a league of their own over there. But the other three are focused on fighting inflation, which is coming down too slowly for them, but they're going in different speeds, like Bank of England surprisingly double, and ECB being more hawkish in the commentary than Powell. And Powell sort of soft promising, or at least saying that it's a good guess that we're going to have 2 more rate hikes on the dots. You know, a lot of the strategists are writing about it this morning, this conversation and what they're looking for. Just for some flavor, guys, from the BMO note this morning, the trading note. Powell speaks on Wednesday with the heads of the ECB, BOE, and BOJ on a policy panel that is likely, say, to outline the progress made globally in reestablishing.
She's hosting that, by the way. We'll be watching
such efforts. That's the whole game, right? And another, Dave Lutz also writes about it at the top of his notes. We want to see how much more they're looking to squeeze borrowers. And the other interesting element to this conversation is going to be Russia, because the geopolitics are back on the front burner. And that's what happened over the weekend. We don't know if there's going to be much market reaction to this. We've got our eye on the oil market because obviously Russia is still a key exporter. And Europe has so far gotten by with lower natural gas prices. But if this is seriously a threat, or at least breaks the sort of air of invulnerability of Vladimir Putin, what does that mean? I think it raises a lot of questions. And I think it raises a lot of questions for investors and for central bankers too, especially the ones in Europe that have to deal with the energy repercussions.
Without a doubt. I mean, I know we were probably all glued to our whatever it was on Saturday morning, certainly, as Rosen was potentially making his way towards Moscow, only to then turn around. But it did raise any number of, an endless sort of stream of questions, of course, many of which we still have no answers to in terms of what it will ultimately mean. Of course, the war continues, very much so, Carl, at this point in Ukraine, but perhaps strengthening their hand as Russia does seem to be at least occupied perhaps in other ways.
Ruble initially dropped 3% on the open, and then it kind of came back. We look at that as the barometer, obviously, for confidence around Russia and the markets, although it's hard to get a clean read on that. And then, oil market has behaved, but we'll keep an eye on it.
The only other market, guys, that we'll get to later is the private markets, which have been sort of ascendant today, whether it's the Wolfspeed deal and the $2 billion coming from Apollo, whether it's Pelagius buying a portfolio out of Blackstone of industrial, which we'll get to, whether it's an SL Green deal, whether it's Vista selling a business to IBM. The private markets are actually taking the lead from the public markets, at least when it comes to news this morning, all of which we will get to.
Yeah, and some pretty encouraging news, at least for commercial real estate in New York City,
potentially,
as part of that story. But we do want to get to the fallout from the mercenary armed revolt in Russia over the weekend. We turn to NBC News chief foreign correspondent Richard Engel, who joins us this morning from Taipei. Richard, great to see you. Your thoughts about the weekend?
Well, I think this was a massive blow. You just said it a couple of minutes ago. This penetrated this air of invincibility around Vladimir Putin. Dictators, all dictators, Putin included, survive for one reason. They only have one responsibility. That is to provide stability for the elite. No dictator operates alone. They have an inner circle. And Putin's job for the last 23 years has been to enrich himself and enrich his inner circle and make sure that their money is safe, their power is secure, and their privileges remain consistent. And if he is unable to continue to guarantee that, and now there are serious doubts if he is going to be able to continue that role, it raises questions about his ability to maintain the elite's loyalty. In 2020, a referendum was passed, and there's no real referendums in Russia, like there's no real elections. It was passed because the elites, the people around Putin, wanted it to be passed, giving him the ability to stay in power until 2036. And he's supposed to be up for re-election.
No kidding. I want to pull off Russia here for a bit, since we did talk a lot about Russia already, though their insights are somewhat useful here. There's a note earlier in the live. We talked about some of these bullishness factors and how there were how the first half and this call option buying could lead to some excitement around the second half being pretty fruitful. Well, there's another piece out, and this is quite interesting. All right, so I'm gonna add this in. So let me write this in really quick here. Okay. This is mind-blowing, but you know how everybody was complaining about the liquidity crisis? Like, oh, liquidity isn't going to be here and stocks are going to crash, and nobody believed me that repos were just going to fall to help refill the TGA, the Treasury General Account. That's exactly what happened. Well, in addition to talking about two bull pieces that we're going to talk about in this segment, look at this piece out now. Stocks have upside potential while excess liquidity is now rising. Yes, I'll hide myself here for a moment. Now, all of a sudden, the mainstream narrative has flip-flopped. It's gone from, oh my God, there should be a lack of liquidity, to, ooh, liquidity is rising. This is going to be great for stocks in the second half. Make up your minds, mainstream. But then there's also another indicator, which we used about 3 to 4 months ago last. It was really quite interesting. It's this indicator that pretty rarely fires. We last covered, it's this indicator called the Kopach indicator. We last covered this about 3 to 4 months ago, and it fired off a signal that maybe now is turning into buy time. And that indicator is right here again, and it is reiterating through an adapted version, yet another buy signal. So two bullish signs leading into two pieces on what the rest of the market might have in store for us for the rest of the year. So kind of exciting. Obviously, we talked about those two exciting pieces a little earlier. For now, I will remind you to check out the programs on Building Your Wealth link down below. You get lifetime access to the course member live streams, fundamental analysis on real estate, fundamental analysis on stocks, entrepreneur questions, Q&A, whatever. You get lifetime access. So if you ever have a question, you know, people love it. They pop in. It's like something comes up. They're like, hey, Kevin, what do you think about this? You know, that you don't have to be there every day, although thousands of people tune in every single day in the course member live streams, either to watch them back on replay or, some like to come live. And we do those at the morning bell. So I'd love to have you there. But anyway, thank you so much for watching. We'll see you soon. I got to go and get ready and make another cup of coffee and get ready for that live stream. So we'll see you there.